After experiencing wars, economic crises, and bank runs, the federal government finally began drafting the Federal Reserve Act. And in 1913, the Federal Reserve was officially established. The design of the Federal Reserve System is actually quite ingenious. You might wonder, why didn't the United States have a central bank before? The design of the Federal Reserve System is actually quite ingenious. You might wonder, why didn't the United States have a central bank before? It's because the public didn't trust the central government and didn't want the government to have the final say. However, if you establish an institution completely independent of government control, the government certainly wouldn't be pleased either. So, during the discussion of the Federal Reserve's operational mechanism, the government and private bankers underwent intense negotiations for 3 to 4 years before finding a balance that everyone could relatively accept. Let's take a look at how they resolved this. The full name of the Federal Reserve is the Federal Reserve System, not the Federal Reserve Bank. So it's not a bank, but a system composed of 12 regional reserve banks. These 12 reserve banks each have their own jurisdiction, responsible for managing all the commercial banks within their region. These regional banks do have some autonomy in administrative affairs, but when it comes to key monetary decisions like raising interest rates or printing money, there is still a centralized decision-making body at the federal level called the Federal Open Market Committee, FOMC. This committee is extremely important. It consists of 12 people who make all the major monetary policy decisions for the United States and is the core decision-making body of the Federal Reserve. Imagine this: 60% of the world's foreign exchange reserves are in US dollars, and decisions on how much money to print and what the interest rates should be are all made by these 12 people during their meetings. For example, discussions on whether to raise interest rates can immediately pull back hundreds of billions of dollars to the US from around the world. Among these 12 people, 7 are called the Board of Governors, including one who is the chair of the Federal Reserve. Currently, Jerome Powell holds this position, serving a 4-year term that can be renewed. The other 6 members serve 14-year terms. All 7 members, including the chair, are appointed by the president and confirmed by the Senate. The remaining 5 seats are rotated among the presidents of the regional Federal Reserve banks. These 12 people gather 8 times a year, essentially once every 1 or 2 months, for what we commonly refer to as Fed meetings. They discuss the most critical monetary policies. After the meetings, they issue a document called the Statement, which includes the meeting records. For example, decisions on whether to raise interest rates and by how many basis points are announced after these meetings. This is a major focus for global financial markets because the FOMC is incredibly important. We generally categorize these 12 people into doves and hawks.
For instance, previous chairs like Ben Bernanke were typical doves.
Janet Yellen also leaned towards being a dove.
The current chair, Jerome Powell, is relatively neutral.
To illustrate the importance of these 12 people, Neel Kashkari became the president of a regional Federal Reserve Bank in 2016, and he is a significant dove. His appointment alone caused the stock market to rise, showing just how influential these 12 people are.
The Board of Governors, the FOMC, the regional Federal Reserve banks, and the member banks together form a simplified framework of the Federal Reserve. The core idea reflected in this framework is balance. Balance between the government and private banks. It's important to know that when Jerome Powell was appointed as Fed chair, he was personally nominated by President Trump.
However, shortly after, Trump started criticizing him, saying that he believed the Federal Reserve was a bigger problem for America than China, and that they made a huge mistake.
The US government's control over the Federal Reserve is actually quite weak. Even if the president personally nominates someone, that person may not necessarily follow his directives. Powell himself has mentioned in interviews that the complex operational mechanism is designed to ensure the independence and impartiality of the Federal Reserve's decisions. This is because the market, the Federal Reserve, and even the US government understand that the foundation of the Federal Reserve is trust. While the Federal Reserve holds significant power, this power is based on market trust. The more the global market trusts you, the more people will use your currency, and the greater your influence will be. This creates a positive feedback loop, and the Federal Reserve's neutral mechanism is in place to maintain this trust.